This refers to living animals and also crops. And then we also define what are agricultural produce. Agricultural produce, basically, we say these are those produce which are harvested from biological assets. Remember, you said biological assets, these include like living crops. If, for example, maybe you're a maize farmer, you have some maize which are growing in your farm, those are biological assets. If you're, for example, a dairy farmer, you have some dairy cows within your farm, those are biological assets. So any harvested produce from those biological assets like milk, like maybe dry maize, all these are good examples of agricultural good produce. And in this case, we said that a biological asset basically should be recognized as an asset in the statement of financial position, but subject to meeting three conditions. Number one, we said biological assets, or basically the value of the biological asset, that is the fair value of the cost, has to be measured reliably. Number two, the asset must be controlled by the entity. And number three, we said it is probable that future economic benefits will flow into the entity from that particular asset. So once a biological asset meets those three conditions, we said it has to be recognized as what? As an asset. Then from there, we looked on how we initially and subsequently determine the value of biological asset, of which we said initially and subsequently, biological assets should be measured at the fair value less cost to sell. So the fair value we said is the current market value, and then we deduct the cost which will be incurred if the entity decides to sell such biological assets. Then from there, we talked about the preparation of financial statements by those entities, by those companies which are involved or which basically undertake farming or agriculture activities. We talked about three components of financial statements. Number one, we talked about the revenue account, which we said is an account which is prepared to determine the performance of different departments within a farming business. We said, if, for example, you're a commercial farmer, you may be involved in some form of crop farming. You may also be involved in some form of livestock keeping. Those, we said, are different departments. And therefore, we said, you have to ascertain how each department is performing. How do you do that? We said you have to prepare something called a revenue account. And therefore, usually we said we have two types of revenue accounts. The crop revenue account, which is basically prepared to ascertain the performance of any form of crop farming. And then we also talked about the livestock revenue account, which is said is prepared to ascertain the performance of any form of livestock keeping. And actually, we looked at the format for that account, which you said has to be prepared using the T format. Then from there, we also looked on how to prepare the statement of profit or loss, which we said is prepared to ascertain the performance of the entire farming business, not the performance of specific department, but the performance of the entire company or the performance of the entire business, whereby we said we take the incomes and then we less the general expenses. Also, we looked on how to prepare the statement of financial position, of which we said statement of financial position. This one is basically prepared to ascertain the position, and we said it is prepared based on the accounting equation. Accounting equation states that assets are equal to capital or equity plus what? Plus liabilities. Then from there, we also discussed on the treatment of various transactions within what? Within, or basically when preparing its fair value of 24 million. So we are told the cost of land is 6 million. So automatically the difference here is the cost of buildings, because we are told a property, we are given property fair, and actually in this case we are told the property was revalued. So the revalued amount in this case we are told is 24 million. And I hope you can see our figures in the income statement of financial position. Those values are in thousands of shillings. So we need to be consistent. We will work with our figures in thousands of shillings. So the property, which I've said comprises of land and buildings, land and what? And buildings. This one was revalued to this one, 24 million. And basically we are told that the cost of land, or basically the revalued amount of land here is what? is 6 million. So automatically, the difference here, which is 18 million, this is the revalued amount of what? Of buildings. This is the revalued amount of what? Of buildings, because I've said property comprises of land and buildings. Yes, and then you're told the property had a cost of 25 million. So the cost of land in that 25 million is 5 million, and the building was being depreciated on a straight-line basis at the rate of 2% per annum, and had a remaining useful life of that year at the date of the revaluation. At the date of what? Revaluation. So, and then you're told that the company does not account for the deferred tax on this revaluation. There is a topic you're going to discuss on deferred tax, and basically we'll be able to see that anytime the company revalue an item of PPE and there is a revaluation gain, the company usually computes something called the deferred tax on the revaluation gain. But if you check here, we are told the company does not account for that deferred tax on the revaluation gain. However, it makes an inter-reserve transfer for excess depreciation upon what? Revaluation. So I think in our case, what we need to do here is basically to compute what? We need to compute the accumulated what? Or actually, we need to compute the excess depreciation here. The excess depreciation. Do we compute it at this point, or we compute it as we prepare the PP account? Yes, let's compute that as we prepare the PP account. Remember, I've said we need to prepare the PP account and the accumulated depreciation account. Yes, let's first of all skip that. We will basically come back to that equal to note number 1. So let's first of all move to note number 3. And in note number 3, we are told during the year which ended 31st of October 2025, a motor vehicle which had a cost of 2 million and accumulated depreciation of 800,000 was disposed of for a cash proceeds of 1080. The gain or loss on disposal was included within the distribution. I think this one is quite simple because we are told there was a motor vehicle which was disposed. Remember, I said that anytime the company disposes or sells an asset, we need to compute the gain or the loss on disposal. How do we compute this particular gain or loss on disposal? We said we take the sales proceeds minus the net book value, or basically the carrying amount, of which we say that this one is equal to the cost minus the accumulated depreciation. So in our case, we are told the motor vehicle, which was disposed as per note number 3, was disposed, or actually we are told its cost was 2 million and accumulated depreciation of 200,000. So the cost was 2 million, and you have said you are working with all our figures in thousands of shillings. The accumulated depreciation was 800,000. So meaning that the net book value of the carrying amount, this one was 12. And then you're told it was disposed for 1020. That is the proceed. So meaning that here it was sold at an amount which was less than the carrying amount. In other terms, if you take this minus that will give us a negative. That one will give us a negative, which automatically is the loss on disposal. So what is the loss on disposal here? Is it 180? The loss on disposal? The loss on disposal, is it 180? Is it 180? Is it 180? 180? Yes, 180. So remember, when preparing the statement of cash flows, there are 2 items you're going to consider here. Number 1, this one, the loss will have to be added to, will be added back to the profit before interest and tax. And number 2, when computing the cash flow from investing activities, we said we take into account the sales profit. How much amount was received from the sale of that asset? So we are done with that. So, but also remember this information which we have in note 3. We will also use this when preparing the PP account. Let's move to note number 4. And you're told the company acquired new investment in equity instruments for a cash and designated them at fair value through other comprehensive income. Remember, in the topic of financial instruments, we talked about financial asset. Financial asset, we said it is investment in equity instrument. It is investment in shares. So we are told during the current year, the company acquired new equity, or actually the company acquired new investment in equity shares. In other terms, the company acquired additional investment in what? In shares, and actually designated that, or actually classified those particular investment as at fair value through other comprehensive income. Now, where do we have information about that? Where do we have information about the financial asset? Remember, this was the abbreviation for those financial asset at fair value through other comprehensive income. And remember, we said that these are equity instruments which are acquired by the company, and the company has an intention of holding them on a continuing basis. The company has an intention of holding this equity instrument for a long period of time. That's why we said these ones are basically classified as non-current asset. If you go back to the balance sheet of this company, specifically at the non-current asset, you'll be able to see something called equity or investment in equity instrument. Now, that investment in equity instrument basically is what is a financial asset at fair value through other comprehensive income. Investment in shares, the company intends to hold these shares for a long period of time. Now, here you can see at the start of the year, the value for this equity instrument was basically 0, but basically it has increased all the way to 12,100. That's why we are told in note number 4 here, this investment in equity instrument was acquired during the current year. So in this case, you can see therefore, this has an increase of 12,100. But remember what we said, this particular investment in equity instrument, they are recorded in the statement of financial position at their fair value. So they must be remeasured to their fair value at the end of each year. Now, if you can be able to recall in the income statement, can you go back to the income statement? Can you go back to the income statement? In the income statement down there, where we have the profit for the year, we have other comprehensive incomes. Now, these other comprehensive incomes, basically, we have 2 items. We have the gain on property revaluation, and then we have fair value gain on equity instrument. So basically, this investment in equity instrument, which was acquired by the company during the current year, their fair value increased with 600,000. So the company bought some shares during the current year, but when the year was coming to an end, their market value had increased with 500. Now, in our case, what we want to do here, we want to determine how much cost was paid by the company in acquiring these shares. So automatically to be able to determine the cost, because whatever you're given here, this is the fair value. And this fair value of this equity instrument, this one includes the gain. Include that gain. Can you be able to know how much amount was paid by the company? For example, you bought some shares during the current year. We don't know the amount which you paid, but we know that at the end of the year, these shares will be having a value of 50,000. But equally, we are told that the value for these shares has increased with 10,000. Now, in this case, can we be able to determine the cost you paid in acquiring these shares? Because that's what we need to know here. So we know that the market value of the shares at the end of the year was 50,000. The market value increased with 10,000, but we don't know the cost you paid. Can you be able to determine the cost which was paid here? Then, can you be able to determine the cost which was paid here in acquiring these shares? I hope you're understanding this, whatever I'm explaining here. We are saying you bought some shares during the current year, the shares which are trading in the securities exchange market. Now, we don't know the cost you paid, but we know the market value of those shares at the end of the day is 50,000. And we are told since you bought those shares, their market value has increased with 10,000. Can you be able to determine the cost which was paid in acquiring those shares? Can you be able to tell the amount? Can you be able to determine the cost you paid in acquiring those shares? Yes, it's automatically very, very simple, this one. It's automatically very simple. Dagote, can you be able to determine the cost? Yes, the cost is automatically the market price minus the increase in the fair value. So you bought them at 40,000. You bought them at 40,000. And If you add this increase in the market price, you get their fair value at the end of the year. The same case here. The shares which were bought by the company, we are not given their cost, and that's what we want to know, how much cash was paid, but you are given their fair value at the end. But we know that this fair value has increased with 600. Has increased with 600 as per the income statement. So meaning that we can be able to know, to determine the cash which was paid by the company. So the cash which was paid by the company in acquiring this equity, this investment in equity instrument will be this minus that. So how much is that? It is 11 what? It is 11,500. That is what we want to determine, because in preparing our statement of cash flow, specifically when computing the cash flow from investing activities, our interest here is basically to determine, our interest is the cash which was paid. The cash which was paid is not this one. The cash which was paid is 12,600, which is the market value, minus that gain, minus increase in the market price, minus that increase in the market what? Minus that increase in the market price. Sasa, yes. Now we have that. Note number 4, note number 5. We are told during the year which ended 31st of October 2025, our company made 1-for-5 bonus issue of ordinary shares utilizing share premium. We came across this in our previous class. We said once the company make a bonus issue, there is no money which is received here. So let's first of all determine the bonus shares. How many shares were issued free of charge? So we are told the company issued 1-for-5. 1-for-5, how do we interpret that? We interpret that, or basically that means that during this bonus issue, the company was to issue 1 share for 5 shares which were held. Now in this case, we said we need to determine the shares which were held at the start. So we go back to our balance sheet at the equity. And we take the share capital at the start. The share capital at the start was 20. I hope you can see that. But basically, these are not shares. We say divide that with the par value per share. The par value per share is what? Still in our balance sheet where we have the word ordinary share capital, the par value is 10. So meaning the shares which were held at the start, they were 2,000. So we cross multiply, then we divide. So in this case, we have 1 times the 2,000, that is, divided that with 5. And basically, this will give us what? This will give us 400 shares. So the shares which were issued during the bonus issue were 400. And remember, in this case, we said during a bonus issue, the shares are issued at their par. Exactly the same thing we did in the other question. So that is these are the shares which were issued during the bonus issue. Now, meaning that this particular 400 shares, and I hope my computation is correct. So the 400 shares which were issued at a price of 10, so the company received 4,000 shillings. So how do we account for this amount? We say that this one should be credited in the share premium account. And then we credit the ordinary share capital account. We credit what? The ordinary share capital account. That is basically the double entry for this. And therefore, we said in relation to this bonus issue, we have to prepare 2 accounts, the ordinary share capital account and the share premium account. So why do we have to prepare those 2 accounts? For us to be able to determine the shares which were issued for cash. So let's prepare those 2 accounts. We prepare those 2 accounts. And I hope you can see this question, in fact, has so many similarities with the other one which we did. Because also in that question, we had a bonus issue. There was a disposal of assets. Yes. So let's start by preparing the ordinary share capital account. And then the share premium account. And I've said the reason why we are preparing this account is to determine the shares which were issued for cash. And in this case, I said whatever you record in this account is the opening balance. The closing balance, we record it here. the closing balance. Then these bonus shares must be credited in this account, the bonus shares. The bonus shares, and we know the bonus shares at this value, 4,000. Then this account mostly will be having a balancing figure on this side, and these are the shares which were issued for cash. That is what we want to determine, which will be the balancing figure. Then we do the same. We record the opening balance in this account, the closing balance. Then these shares which were issued free of charge, the bonus shares, we are saying they should be debited in this account. So we have the bonus shares, which are the value of 4,000. And then we will have a balancing figure on this side, which now will be the cash, which was received from the shares which were issued. These shares which were issued, you'll be able to see they were issued at a premium, which will be the balancing figure here. So let's first of all start by recording the opening balance and the closing balance in the share capital. We get this from the balance sheet at the equity. From the balance sheet at the equity, the ordinary share capital at the start, this one, was 20. At the end was 40. Was 40,000, like that. Yes. So then if you balance this account, you can see the total on this side is 40. The total on the credit is 24. We have a difference of what? We have a difference of 16,000. Now this 16,000 automatically are the shares which were issued for cash. And that is what we consider in our statement of cash flows. The same case here, we record the opening balance. We are getting this balance from our balance sheet at the equity. The opening balance here is 4,000. The closing balance here is 4,000. 4,000, 4,000. So the total on this side is 8,000. The total on this side is 4,000. So meaning that we have a balancing figure here of 4,000. And this is the share premium which was received in cash. That is what we are going to consider in preparing our statement of cash flow. That is what we will consider there. So I think we are done with that point number 5. And then I think point number 6, you are told all the sales and purchases were basically made on credit. Okay, so I don't know how that is supposed to help us, but I don't think we have any working for that. Now, what I want us to do, I want us to go back basically to point number 1, 2, and 3. There are basically a number of accounts we need to prepare there. The number of accounts we need to prepare there, the PP account and accumulated depreciation. I hope you can see, for example, with this question, like unlike the other question which we did, we are not given the depreciation for the current year. Are we given the depreciation for the current year in the additional information? No. We can only compute that by preparing the accumulated depreciation account. In this question, equally, we are not told whether there were some items of PP which were acquired. So we can only be able to do that by preparing the property, plant and equipment account, of which in this case we'll be able to see that in terms of how we prepare this account, there will be a slight difference because the PP account here, we have to prepare it at cost. And then we prepare another account, which is called accumulated depreciation account. But I think before we do that, let's, first of all, we go to note number 2. There is something we need to compute in relation to note 2. So let's go to note 2 first of all. We are told on 1st November 2024, which is at the start of the year, the company revalued its property, of which I've said property is land and buildings, for the first time at a fair value of 24 million. Fair value is the same with the revalued amount. So if you're told assets were revalued and you're given the fair value, that is the same with the revalued amount. So 24, and actually we are told that included here is the revalued amount for land, 6 million. So meaning that buildings were revalued at 18 million. And then we are told the property had a cost of 25 million. The property, this property which was revalued, had a cost of 25 million. And you're told included in that 25 million is the cost of land. Is the cost of what? Is the cost of land. Cost of land. Cost of land. So I think maybe before we move to the other event, to the other sentence, remember, anytime the company revalue an asset, we usually have a revaluation gain or basically a revaluation what? Loss. Anytime the company has revalued an asset, we have a revaluation gain or a revaluation what? loss. Now, how do we compute this revaluation gain or loss? Basically, to compute this, we compare two values. We compare the revalued amount, which in other terms is the fair value. For example, in our case, we know that this property was revalued to 24 million. So we already have this. So we compare this with the net book value. With the net book value, or basically the carrying amount of the asset, which was revalued. And then in this case, we get a revaluation gain or a revaluation loss. Now, in this particular question, the examiner has not given us this. Because if you check on what you're given in note number 2, we are given the cost of the property. So are we supposed to compare this with the cost? No. We need to compare that with the net book value. And actually, we know the net book value is the cost minus accumulated depreciation. So we don't have this one. But in our case, we have this revaluation gain. So the revaluation gain, this one, we have it in the income statement. Can you go to the income statement down there? In the income statement, you are told the revaluation gain on property was this one. So can you be able to determine the revalued amount? Can you be able to determine this revalued amount? Yes. The revalued amount automatically will be the difference between these two values there. So how much is that? Is it 17 million? Is it 17 million? Because property was revalued to 24 million. We don't have the net book value, but we have the revaluation gain. The revaluation gain, which is this one. Remember, I'm saying to determine the revaluation gain, you take this one, you minus the net book value. So we have this one, we don't have this, and we have this. So how much amount do we less from 24 million to get 7 million? In this case, I'm saying should be 17. Should be what? 17. Is that the position? And Sharon, Dangote, is that the position? Ben, is that the position? Jane, is that the position? Yes. So this is the revalued amount. This is the revalued amount. At the date now, this particular asset were revalued. That was the net book value. That was the net book what? Value. But if you go back to that question, to that point number 2, that is, we are told we are given the cost. We are given the cost of this property. The cost of the property at the date of revaluation. And actually the cost here, we are told it was 25. Remember, I've said, once an asset has been revalued, you compare its revalued amount or the fair value with the net book value, because we know that this property comprises of land and comprises of buildings. Automatically, buildings are depreciated, but basically land are not being what? Depreciated. Yes. So included in this particular cost is the cost of land. And actually, we are told the cost of land is what? Is 5 million. Is 5 million. So mean that the difference here, which is the 20, this now will be the cost of, this will be the cost of buildings. That will be the cost of what? Of buildings. But basically, we are told at the time these assets were revalued, automatically we have said that this was their net book value. Sasa? Yes. So now using this information, there is something I want us to compute. There is something I want us to compute as per note number 2. Let's go to sentence number 3 of note number 2. We are told buildings were being depreciated on a straight line basis at the rate of 2%. 2 what? 2%, and had a remaining useful life of that year as at the date of revaluation. So basically what that means is that before the company revalued buildings, the company was depreciating buildings, at the rate of 2%, at the rate of what? 2% per annum. This is how the buildings were being depreciated before they were revalued. Sasa, after they were revalued, we are told that now the buildings are estimated to have a useful life of 30 years. So basically what that means is that these buildings which were revalued now will be depreciated on a straight line basis, over the next 30 years. over the next what? 30 years. So the reason why this information is important, we need to be very clear, because I know these require a lot of understanding. So for you to be able to understand what you want to do next year, you need to understand this. Before the buildings were revalued, this before the revaluation, the buildings were depreciated at the rate of 2% per annum. But after revaluation, we are told buildings are estimated now to have a useful life of 30 years. Yes. Now, why do we need to have this information? The reason why we need to have this information is because of the last sentence of that point. So we are told, however, it made an inter-reserve transfer for the excess depreciation upon revaluation. So automatically, the moment the company has revalued a building, its value increases. Its value do what? Increases. And as a result of that, you'll be able to see that the depreciation which was accounted for during the current year for the buildings is more than the previous depreciation which was computed before the buildings was revalued. So let's compute the depreciation before the revaluation, and after revaluation, you see, will the depreciation increase as a result of the buildings being revalued? So, for example, before the revaluation, before revaluation, how are the buildings depreciated? The buildings were depreciated at the rate of 2% per annum. And I hope you can see that this 2% per annum is on straight line. So if it is on straight line, it is automatically on cost. What was the cost of buildings before they were revalued? The cost of buildings before they were revalued is this one, which is 20. So if we get 2% of this, I think that one should give us, is it 400? 2% of this? 2% of that, will it give us, it's a 400? 400, eh? Yes, 2%, because we do away with 2 zeros, 400. So that is the depreciation before the revaluation. What about after revaluation? After revaluation. Remember, after revaluation, buildings now will be depreciated, used on straight line basis over the next 30 years. So what we need to do, we need to determine what is the revalued amount of buildings. Who can be able to recall the buildings were revalued to an amount of how much? Buildings were revalued to an amount of how much? Remember, the property which comprises of landed buildings was revalued to this one, 24. So tumesema hii 24 million, cost the revalued amount here land ni 6 million, revalued amount here building ni ngapi? Ni 18. So meaning after revaluation, we are going to compute the depreciation for buildings based on the revalued amount. The new value of the building is this. So which is basically 18, and then we are going to depreciate this in the next 30 years. In the next 30 years means to get the depreciation per annum, you take the new value, you divide that with 30 years. So this will give us what? This will give us 600. So in this case, now you can see before the buildings were revalued, the depreciation per annum was 400. After the buildings were revalued upward, the depreciation increases to 600. Now, what is the excess depreciation? What is the excess depreciation? The excess depreciation in this case is the difference here, which is 200. You can see the depreciation increased with how much? With 200. So that is why it was important for you to understand all this. Now, having said, although in an examination setup, to kifanya revision, you'll be able to see that all these workings, you don't have to do them in an exam. Basically, we are going to look on some of the shortcuts, which are basically required maybe whenever you are doing these questions, because you can see in an examination setup, you can't be able to do all this. So what I want us to do, I want us to basically move and prepare two accounts here, the PP account and basically the accumulated depreciation account. So let's prepare these two accounts here. So we start with the PP account. And this question here, we will prepare this account at cost. This account will be prepared at cost. Will be prepared at cost, and then we prepare this other account, the accumulated depreciation account. The reason why we're preparing this account is to compute depreciation for the year. The reason why we're preparing this account is to determine the PP which were acquired. So what do we record in the PP account? So we record the value at the start, and actually remember everything here will be recorded at cost, and then we record the cost at the end of the year. So then on this side, we record any revaluation gain. We record acquisitions. Then on this side, we record disposal. The revaluation what? The revaluation loss. Any revaluation what? Loss. Any revaluation loss? Yes. Then in this account, what do we record? We record the accumulated depreciation at the start. And then on this side, we record the depreciation for the current year, which was taken to the income statement. We record the accumulated depreciation at the end of the current year here. At the end of the current year. And also because there was an item which was disposed, the accumulated depreciation on disposal. The accumulated depreciation on disposal. So we have everything here. The opening balance, the closing balance, this one we have it. So what we want to compute is this. So in this question, we have this, we have this, we have revaluation gain. Automatically, we don't have a loss. We have the item of PP which were disposed. So what we want to determine is that. So let's start with this accounting fact. So we have the opening balances for accumulated depreciation in note 1. The accumulated depreciation in note number 1 at the start, which is the year 2024, is basically 9240. Note number 1, I'm getting that from note 1. The accumulated depreciation at the end, this one, is 10430. Then if you go to note number 3, the motor vehicle which was disposed, remember motor vehicle is part of the PP because these include property, plant and equipment. Property, plant and equipment include all tangible, non-current assets, including buildings, land, motor vehicles. All of them are part of the PP. So the motor vehicle which was disposed in note number 4, we need to record its accumulated depreciation here. So its accumulated depreciation is 800. So we get the balancing figure here, which will be what? Which will be what? Will be the depreciation for the current year. Depreciation for the current year. So 800 plus 10430 minus 9240. So, and basically I'm getting a figure of 1990. That is what I'm getting there. Confirm whether you're getting the same. So then we need to record the costs at the start, the cost at the end, using the information we have in note number 1. So the cost of PP at the start is 33,400. Remember, I said this account we are preparing it at cost here. So the cost at the end is 47,900, like that. And then the revaluation gain. Remember this one, we have it in the income statement. We have it in the income statement. Income statement. So in the income statement, revaluation gain, which is basically 700 here. Yes. And then we also have the disposal. This one is what we have in note number 3. The motor vehicle which was disposed in note number 3. And I've said everything in that account will have to be recorded at cost. So the motor vehicle which was disposed in note number 3, we record it here at cost. Sasa, yes. So what we do, we get the balancing figure which is on the debit side, and that is the PP which were acquired. That is the main objective of preparing that account. What do we have on the credit side? 47,900 plus 2,000 minus what we have on the debit. 33,400 minus 7,000. So in this case, I'm getting 95. 95. Confirm whether you're getting those values so that now we can be able to move and prepare a statement of cash flows. Are you getting those values? If you're getting those values, you confirm. You confirm whether you're getting those values. Yes, are you getting those values, Dagote and Sharon? Ama swali imekuwa ngumu? Yes, I know this question is a challenging one, but it's a very good question. If you understand it, it's a very good question. It's a very good question on a statement of cash flows. It's a very good question. Juma, are you getting that? Are you getting those values? Are you getting those values? Are you getting those values? I will presume yes. Yes. So I think now we can be able to move and we prepare our statement of cash flows. But even before we look on we prepare the statement of cash flows, someone may ask, how is this excess depreciation accounted for? This excess depreciation. Now, this excess depreciation, the double entry for this is usually debited in the account which is called the retained earnings. Is it the retained earnings? No. This one, in other terms, let me put it like this instead of giving a double entry. This one, excess depreciation, this is deducted from the revaluation gain. You see, the reason why there was excess depreciation is because the assets were revalued upward. So this one is basically deducted from the revaluation gain. If, for example, you go to a balance sheet, to a statement of financial position under equity, can you go to the statement of financial position under equity? Under equity, can you see we have something called the revaluation reserve? Under equity, can you see something called the revaluation reserve? The revaluation reserve is an amount of how much? Then revaluation reserve, which is under equity. Who can be able to see the revaluation reserve? It is 68. But, and actually you can see at the start it was 0. So what we know is that revaluation reserve basically arises from this revaluation gain. Can you remember the revaluation gain? The revaluation gain was 700. But I hope you can see the amount which was transferred to the revaluation reserve account is 68 instead of this one. So now this excess depreciation number 1 is deducted from this. That's why you can see the amount taken to the revaluation reserve is 68. So this one is deducted from this revaluation gain. And then number 2, it is added to the retained earnings. It is added to the retained what? Earnings. And therefore, when computing the dividends, remember the other question we did, we were computing the dividends paid using the retained earnings. So when computing the dividends paid using the retained earnings, we must remember to capture this. So tutachukua retained earnings at the start of the year, and then we will add this amount of 200. Sasa? Yes, because this excess depreciation is how it is accounted for. It is deducted from this revaluation gain. It is then added to the retained earnings. Sasa? Yes. So when computing the dividend paid, lazima tukumbuke hiyo amount ya 200 to add it to the retained earnings at the start. Sasa? Yes. So having that, let's move and prepare a statement of cash flows as required by the examiner. So the name of the company is 𝐴𝐎𝐿 Limited. And basically this is a statement of cash flows. A statement of cash flows, which is for the year which ended 31st of October 2025. A very good question on cash flows. Very, very good question on cash flows. Yes, so remember here we said we start by determining the cash flows from operating activities. We need to have 2 columns here. And basically our figures are in thousands of shillings. Our figures are in thousands of shillings. Are in thousands of shillings like that. So when computing this, we said always start with the profit before tax. Not before tax. Yes, the profit before tax. Always the profit before tax is an amount of 2880. 2880. Remember, we get this from the income statement, profit before tax, and then we make a number of adjustment to this profit. We make a number of adjustment to this profit, and we say the first adjustment to be made to this profit should be to add back the finance cost, such that we have the profit before interest and tax. So the finance cost is just above that profit. I hope you can see it somewhere. Can you see that profit somewhere, Ben? Vanessa, can you be able to see that profit somewhere? Not profit, rather. Can you be able to see that finance cost somewhere in the income statement? Can you be able to see that, Jacqueline? Can you be able to see that finance cost? Yes, it is 1,000. It is 1,000. So basically, after adding it, we have now the profit before interest and tax. Then from there, we said we need to make a number of adjustments to this profit. And actually, we said, first of all, we adjust our profit with the non-cash items. So we said, just recall that acronym, dial G. So this one stands for depreciation. Depreciation on what? Property, plant and equipment. This one stands for impairment loss. Impairment loss on goodwill. So actually, in this question, we don't have this. This one stands for amortization of intangible assets. Equally, in this question, if you check on what we have under the non-current assets, under the non-current asset in our balance sheet, we don't have intangible assets. Equally, we don't have this. This one stands for loss on disposal. Do we have the loss on disposal? Yes. Working 2. We have a loss on disposal of 180. We record it here. And remember, you said that these 4 items should be added, but the gain should be deducted. So then this stands for gain on disposal. Do we have a gain on disposal? No. So we don't have this. We have this. We don't have amortization. We don't have impairment loss, but we have depreciation. Depreciation is what we have computed here, this one. 1990. 19 what? 1990. So that's basically what we have. Then in this income statement, can you go to the income statement which we have? In the income statement, just above this profit, there is something called investment income. Now, this investment income, we are told they are dividends which were received. Automatically, these dividends which were received, I hope you can be able to recall our company has invested in shares. This investment in shares. So the company, as a result of having invested in shares, it is receiving some dividends. Now, this dividends or this investment income, we said this one is not an income from operating activities. This one is an income generated by the company from where? From investing. So take into account that income is already included here. We need to deduct it. We need to deduct it, investment income. Why are we deducting it? Is because this is not an income generated by the company from what? From operation. It is an income generated by the company from what? From investment. So this one would be considered when computing the cash flow from investing activities. Remember, these are dividends received. These are dividends received. We list them here. Yes. And I think we get the net amount. So that then we proceed and we make the adjustment for changes in working capital. So let's get the net amount. So we will take 2880 plus 1,000 plus 1990 plus 180 minus 150, and I'm getting 5,900. I'm getting 5,900. I'm getting 5,900. 5,900. I'm getting 5,900. Is that what you're getting? 5,900? Are you getting 5,900 there? Are you getting 5,900? 𝐷𝐿, are you getting 5,900? Yes. So then next we need to consider what? Next we need to consider something called the changes in working capital. Next we consider changes in what? Changes in working capital. And basically we said that if you come across a question for cash flow, make sure you get these marks. Because here we said you just consider three items. You just need to record that acronym RIP, not less in peace, but receivables, inventory, and payables. So receivables, inventory, and who? And payables. Then this formula here, opening minus closing, opening minus closing, and then closing minus opening. As simple as that. Now, let's go to where we have current assets. In our statement of financial position, we consider, first of all, the receivables. The receivables, you take the opening balance. Opening balance is the value we have in 2024. Closing balance is the value we have in 2025. Receivables at the start is 5,590 minus the closing, which is basically 65, which will give us negative 910. Write it there as a negative, is a cash outflow. We do the same for inventory, still under the current assets. So opening inventory, which is 6880, minus closing, which is basically 9580. We have negative 27, which is still a cash outflow. A cash outflow. I hope you're getting those values. And then we go to where we have current liabilities. Current liabilities, we consider the payables. Payables, we use that formula, closing minus opening. Closing is 3640 minus opening, which is 31. And basically, I'm getting positive 540. So you can see these marks are quite free, or these are basically free marks. And that's why I said, if you happen to come across a question for cash flow, make sure you get those marks there. Make sure you get those marks there. So having that, I think we can get the net amount, 59 minus 910 minus 2,700 plus 540. So that will give us 28, 30, 28, 30, 28, 30, 28, 30. I need to create some space here. So I will do away with this. So I hope you already have this. So the bonus issue here was the bonus issue, not the bonus issue share premium, 4,000. And the shares which were issued for cash, 16,000. So that's basically what we need to have from these two accounts here. So I need to do away with this. Yes, so in that case, we are getting a net amount there of what? A net amount there of 2830. And then to this, we said we less two items. Number one, we less the interest all finance cost which was paid, interest all finance cost paid, and also we less tax paid. I think we can start by computing this one. For the interest paid, we said we check two items. The interest or the finance cost from the income statement, this one, which is 1,000. And then you go back to your balance sheet, specifically under the current liabilities. Current liabilities, you check whether there is any accrued interest. Do we have any accrued interest under the current liabilities? Do we have any accrued interest? Automatically, no. Ama tuko nayo, 𝐷𝐿? Do we have any accrued interest under the current liabilities? No, we don't have any. So, but in this case, we said if there was any accrued interest, what you do, take the accrued interest at the start, or the interest payable at the start, which we don't have, plus the finance cost in the income statement, which is this one, 1,000, 1,000, 1,000, which is basically 1,000 minus the accrued interest at the end. So the difference, or basically whatever you get, is the interest which was paid. We do the same for tax, but we say for tax, usually in the balance sheet, we have two components of taxes. Under the non-current liabilities, under the current liabilities. So under the non-current liabilities, we have deferred tax. These are tax to be paid by the company in the future. And the current tax under the current liabilities, these are the tax to be paid within the next 1 year. So how do we compute that? We say the approach is the same. Though here now we have two components of taxes in our balance sheet. So we take, first of all, can we go to where we have non-current liabilities? And I want you to understand this because you'll come across this in all questions for cash flow. So the deferred tax at the start is 960. So at the start. And then to this, we also add the current tax at the start, under the current liabilities. Under the current liabilities, the tax which are not being paid before 90. So then to this, just like what you have done for the interest, we take the tax from the income statement. The tax from the income statement, you can be able to see the tax for the current year from the income statement, the tax for the current year, the tax for the current year, the tax for the current year, we can be able to see that is an amount of 940 from the income statement. Then to these, we less the taxes which are not being paid at the end. First of all, we go to where we have non-current liabilities. The deferred tax at the end was 880, and under the current liabilities, the current tax not yet paid was 620. That is how we compute the tax paid, and we use the same approach even in the other question. Even in the other question, we compute the tax paid. So we have 960 plus 490 plus 940 minus 880 minus 620. So this basically will give us what? 890. 890. So basically this is what? This is the tax which was paid. So having that, we move and basically we get the net cash flows from operating activities. Net cash flows from what? Operating activities. So we need to work out that. So we have 2830 minus 1,000 minus 890. So basically this one will give us what? Will give us 940. The net cash flow from what? From operating activities. So next, we determine the net cash flow from investing activities, or basically we determine the cash flow from investing activities, cash flows from investing activities, Now, what do we consider here? Number one, asset which were acquired. Number two, asset which was disposed or sold. And number three, any income generated from investment. That is basically what we consider here. And I think we have everything which is required here. I think we can start with this investment income in the income statement. This we said is an income generated from investing activities. So we have investment income, which is basically an amount of 150. And this one here it is considered as an inflow. Remember, this money which was received by the company from investing. So these are cash received from investing. So what else do we consider here? In note number 3, there was disposal of motor vehicle. Note number 3, and remember in this case we said what we consider here is the sales profit. How much amount was received from selling that motor vehicle? As per note number 3, it was 1020. This 1020 is still a cash inflow. Is still what? A cash inflow. Now, still, as per the information we have in note number 4, we have this investment in equity instrument which was acquired. In other terms, we have these shares which were bought by the company during the current year. So we talk of investment in equity instrument, investment in equity instrument. So these are shares which were acquired. This is an investing activity. So we consider the cash which was paid, this one, which is 11,500. And this one is a cash outflow. Being a cash outflow, recorded there as a negative. Then from this account which you have prepared there, the PP account, we have determined that there were some PP which were acquired at a cost of 95. So we have PP which were acquired. PP which were acquired at a cost of 95. At a cost of 95. I don't think we have anything else here. I don't think we have anything else. So basically what we need to do is we determine the net cash flow from investing activities. Net cash flow from investing activities. So we have 150 plus 1020 minus 11,500 minus 95. So the net cash flow from investing activities is 19,830. 19,830. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. So then next, we determine the net cash flow from financing activities. Recall, we say that all the items which we record here, we basically get them from equity and the non-current liability section. So you just go to your balance sheet, your statement of financial position, at the equity and also at the non-current liabilities. That is basically where you get the items to be included here. Where you get the items to be included here. Can we do that? Can we do that? So we start with the equity section. At the equity, the first item, actually the first two items, we have done some workings for that. Ordinary share capital, share premium. So we have said what we consider here are the shares which were issued for cash and the share premium which was received in cash. And I think we have already computed that from the two accounts we had prepared here, the share capital and the share premium. So we will say there was issue of ordinary shares. And basically we consider the shares which were issued for cash. And I think from our share capital account, 16,000. 16,000. So these are shares issued for cash. We consider that here. And then we also consider the increase in share premium. So the amount of share premium which was received in cash, which is from the share premium account, 4,000. Forward, 4,000. So basically, from at the equity, I think we have dealt with those first, with those two items. Then below share premium, we have revaluation reserve. Revaluation reserve, do we consider that here? No. We say that arises from the revaluation of assets. Revaluation gain is a non-cash item. We don't consider that here. Below that, we have financial asset reserves. Financial asset reserves, equally, we have said, it is the increase in the market value of these shares. This one is also a revaluation gain. A revaluation gain is still a non-cash item. Don't consider that here. Once the market value of an investment increases, no cash which is received from that is a non-cash item. Don't consider that here. So then from there, we have the retained earnings. Remember these retained earnings, we use it in computing what? The dividends paid. And I think I gave you a formula for computing this. We said we take the retained earnings at the start plus profit after tax minus the retained earnings at the end. That is the formula. But in this case, we have said that there was an excess depreciation. That excess depreciation of 200, I hope you can remember that. We have said it should be added to the retained earnings at the start, because we have said that excess depreciation should be deducted from the revaluation gain. This one, the revaluation gain we had of 7,000 and then added to the retained earnings. So therefore, let's compute the dividends which were paid. I will take the retained earnings at the start, which is at the equity, which is basically 20,350. Even before I add this, I must add the 200, excess depreciation. Excess what? Depreciation. And then I add the profit after tax. The profit after tax, I get this from the income statement. From the income statement up there, the profit after tax is the same with the profit for the year. 1940, and then minus the retained earnings at the end, which is basically 40/40, which is what? 40/40. Yes, so you can see this one was a little bit tricky because of this concept of excess what? Depreciation. You needed to compute that. So 2350 plus the 200 plus the 1940 minus 40/40. So basically, I'm getting dividends paid off for 50. Remember, dividends paid is a cash outflow. So record it as a negative. So we are done with all items of equity. Sasa, we go to non-current liabilities. Non-current liabilities, how many items do we have there? 2. So we are only considering 1 because deferred tax is used in the computation of this. So we are only considering 12.5% loan notes. And those 12.5% loan notes, you can see we have an increase in the value. So what causes the value for this 12.5% loan note to increase? The value increases because the company issued additional 12.5% loan notes. So if the company issued loan notes, the company receives some cash. So here we will say there was issue of 12.5% loan notes. So which is equal to the increase. So how much is that increase? Is it 800? Is the increase 800? The increase, is it 800? Is the increase 800? Increase in 12.5% loan notes. At the start 76, at the end 84. Yes, we have an increase of 800. So that is caused by issue. Yes, so we have done. So what we need to do is to get the net cash flow from financing. So we have 16,000 plus 4,000 minus 450 plus 800. So this gives us 20,350. And then now from there we get the net changes in cash and cash equivalents. How do we get that? We said we need to add 3 cash flows. We need to add the cash flow, the net cash flow from operating, the net cash flow from investing, and the net cash flow from financing. Sasa, these 3 cash flows, this, that, and that. So let's add that. We have 940 minus 19,830 plus 20,350. And basically that will give us what? 1460. 14 what? 60. Then to this, what do we add? We add the cash and cash equivalents at the start. The cash and cash equivalent at the start. So this cash and cash equivalent at the start, we have it in our balance sheet at the current assets. So how much is the cash and cash equivalent at the start? Cash and cash equivalent at the start. Who can see that? Yes, the cash and cash equivalent at the start is 18 what? Is 1870. So after adding the 2, we should get the cash and cash equivalent at the end. The cash and cash equivalent at the end. The cash and cash equivalent at the end. Cash and cash equivalent at the end. And how much is that? That one is basically how much? That is plus 1870. And basically that will give us what? That one will give us 33. That. So this 33 that we said it should always reconcile with the value we have in our statement of financial position. Are the two values reconciling? Are the two values the same? 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 Yes, the two values are the same. The two values are the same. So it basically means that we are 100% correct. We are 100% what? Correct. So these are very good questions on cash flow, although it is I feel is a little bit technical. Maybe the 3 marks here, which you could have gotten here, is like this one, this one, this one. No problem with that. The loss on disposal, no problem with that. Even this one, you should get it. But depreciation, I feel that one is more technical. That one you can get it. That one you can get it. Even this tax, make sure you get this. That one, that one. Investment income, that one you can get it. This one you can get it. This one a little bit technical, including that one. But also the share capital. Anytime you have seen a bonus issue, because you can see this question and the other question, there was a bonus issue, you should be in a position to prepare these two accounts. Sasa, for dividends paid, this one also technical. This one I think is okay. And in fact, also those two values are supposed to be marked. The cash and cash equivalent at the start and also at the end. So don't basically record the values from the balance sheet here. Cash and cash equivalent at the start, this one, and also cash and cash equivalent at the end of the year. So let me, for example, see how the marks were located here. How the marks were located. Yes. So this is how the question was marked. N20. N20 at 1. So you needed to have 20 ticks. 20 ticks there. Yes. And I think I've said, like here, you could have gotten this 1, 2, maybe 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So at least that question, even without maybe having prepared the PP account, the accumulated depreciation, and even this particular dividend is a question at least you could have gotten what? 15 what? 15 marks. Sasa, yes, but no need to worry about these so many workings we are doing here. During our revision, we will be able to see how you should handle such a question in an examination setup. Tukifanya revision, we're going to look on how you should approach such a question in what? In an examination setup. Because automatically in an examination, you can't be able to do all these workings which Marimo is doing here. Sasa, because in fact, for you, this question in an examination, you have to do it within 36 what? 36 minutes. So you can't be able to use this particular approach. You can't use this particular approach in an examination what? In an examination setup. In an examination what? In an examination setup. Sawa. Yes, yes. So basically, I want us to stop at that particular point for today. We stop at that particular point for today. We are basically done with that topic here for what? We are done with this particular topic for cash flows. So it basically means that once we meet in our next class, we will move to the next topic. And I hope you can see now we are starting to do very serious topics. So because right now I said we are almost done with the syllabus, around 60 to 70%. Maybe what is remaining is around 40 to 30%. 40 to 30%, because we have like a topic of income taxes. That should take us around 2 classes. We have a topic of borrowing cost. That is 1 class. And then from there, we'll do published financial statement, maybe 2 classes. Maybe conversion of partnership into a limited liability company. And then from there, we go to the last computation topic, which will be the group accounts. Although we have some theory topics, which we will be able to create some time and basically go through them. So therefore, the topics we are doing here are very serious topics, because you can see they are very, very common in the examination. Sasa, Yes, they are very, very common. So we stop at that particular point for now. I don't know whether there is any question before we wind up. I don't know whether there is any question before we wind up. Any question before we wind up? Any question before we wind up? Is there any question before we wind up? Okay, so there is none. So we stop at that point for now. Have a nice afternoon. See you next week. Sales. And then it is also a loss to the entire company, to the entire what company here. Sasa, yes. So let's record the closing inventory we have in note number 1. So number 1, you have the closing inventory for growing crops. So that go to the crop revenue account, which is basically 5,000. 5,000. Then below that we have seeds, fertilizer, and what? And pesticides. So automatically also this is related to crop farming, which is 75. And then we have livestock. Livestock that go to the livestock revenue account, which is 50,000. And then we have livestock feeds. Livestock feeds. So also that go to the livestock revenue account, which is 1250. And I think in our case, we are basically done with this account here. So what we need to do is to balance our account here. And basically we determine whether we have a profit or a loss. We determine whether we have a profit or basically a loss. We determine whether we have a profit or a loss. Now, how do we balance this? The normal way we balance our ledger accounts, but because here we have 2 ledger accounts, we can start with the crop. We can start with the crop. So we get the total on the debit side and the total on the credit side. We compare. So let's first of all, we get the total on the debit side for the crop, which is basically 25,000 plus 25,000 plus 5 plus 12.5 plus 6 plus 1.5 plus 300. So I'm getting 44,300. So confirm whether you're getting the same. We compare that with what you have on the credit side, 43.75 2.5 plus 1.5, 1.5 plus 6.5 plus 5 plus 7.5. And basically I'm getting 66,750. Are you getting those values? Are you getting those values? Confirm whether you're getting those values. Confirm whether you're getting those values. Those values. Are you getting those values? Ben is getting 50. Okay, so my addition is wrong then. 5,300. What about the total on the debit? The total on the credit? The total on the credit? The total on the credit side, are you getting that value? 66,750. Now, these items are in note 1. Who is asking about the crossing inventory? Crossing inventory, we have it in note 1. We are picking the items in note number 1. They are not in the Betty. Those crossing inventory is not in the additional information. Crossing inventory, remember Betty, always it has to be part of the crossing inventory, even in the lower level. In financial accounting, crossing inventory was not given in the trial balance. It was given in the additional information. We got that in the additional information number 1. Crossing inventory. Yes. So it basically means that the amount which is more is what you have on the credit. Now, when balancing a ledger account, whatever you record here is the amount which is more. Out of the two totals, we pick the one which is more. So 66,750. We record it on both sides. We know if we add all this, it will basically give us that. If we add this, all what we have here, are we going to get 66,750? Automatically no. So we get 50,300. So we have a balancing figure on this side, which will be the profit for the year. Will be the profit for what? For the year. So how much is the profit? 66,750 minus 50,300. So that will give us 16,450. 16,450. So we do the same for the livestock revenue accounts. Let's get the total on the debit side. We have 30, we have 7.5, we have 16.25, we have 0.875, we have 15.37, we have 6, we have 0.3. That is basically what I'm getting. What about on the credit side? We have 60,000 plus 18,750 plus 50 plus, and here I'm getting 130,000. I'm getting 130,000. Also, my total here is also wrong. Yes, correct. Okay, I think the total is on the credit is okay. On the debit side, you're getting what? On the debit side, what are you getting? What are you getting on the debit side? 76 to 95. 76 to 95, 76 to 95, 76 to 95. Yes. So then we balance. So we pick the amount which is the total which is more, which is 130. We record it on both sides. So automatically If we add all this, it will give us 130. If we add what we have here, it will not give us 130. It will give us this. So the difference between 130 and that should be the balancing figure there. And automatically, that is also a profit. It's also a profit of 53,705. 705. Yes. So basically, this is what was required in number one of that question. And basically, remember, you see that this particular account is prepared. These accounts are prepared to ascertain the performance of this department. Remember, we say that these are like department within this company. They are department within this what company? Livestock farming, and also that is crop farming and livestock keeping. So basically, they are what? They are the department. So having that, then, so I think we can be able to move and we prepare what is required in part B of the question. Part B of the question. So in part B, we are required to prepare now the general income statement. The general income statement, or basically the general statement of profit or loss. The general statement of profit or loss, which is basically for the year, which ended 30th of June 2025. 30th of June 2025. So this one, remember, is prepared to ascertain the performance of the entire company. The performance of the entire what? Company. We take the incomes of the company, we minus the general expenses. The general expenses. So any expenses which has been captured here should not be included here. So we start with the incomes. In this case, we will have two columns here. We have two columns. So the incomes, basically, we start with this profit. We start with this profit from this revenue account. So this profit from crop and also livestock farming, they are income. So we have profit from the crop account and also from livestock. So this one is 16 or 50, and this one is 53,705. 705. So then from there, we need to check whether was there any other income which was generated by this particular company here. So remember, when checking for incomes, you should go back to the trial balance, check the items on the credit side, check whether there was something like investment income or something like that. And I think in the trial balance, we don't have any other income. But recall, there was the insurance compensation. There was the insurance compensation as a result of destruction of the crops. So this one we said has to be accounted for as an income. So and the insurance compensation was 90% of the value of the crops which was destroyed. 90% of 65. Was that 5850? 5850. 90% of 6.5. Is that what we got? I think I was given that value. Yes. So in our case, we don't have any other income. So we get the total incomes. And then to this, we proceed and we less the expenses. And remember, in this case, the expenses which we less here are basically the general expenses. Any expense which has been considered here should not be included here. So first of all, we get total incomes. Total incomes here, 16,450 plus 53,705 plus 5850. And this will give us what? This will give us 76,005. 005. I hope you're getting those values. Yes. So can we then proceed and we record the general expenses? The general expenses are the other expenses other than what we have here. Let's start with the additional information. We have dealt with the note number 1, Note number 2, we have dealt with that. And then note number 3, we have dealt with that. Note number 4, let's compute depreciation on farm machinery. Depreciation on farm machinery. And this one we are told will be 20% on cost. 20% on cost. What is the cost of farm machinery? Farm machinery is basically the second item in the trial balance. We are given the cost inside the bracket as 135. Automatically, the value which we have in the trial balance, 97,500, that is the net book value. That is the net book value. So therefore, the difference, for example, between 135 million and 97.5 million is the accumulated depreciation. So the reason why we given that 135 is for us to be able to compute the depreciation here. So this one will be 20% of 135. It will be computed based on cost. Computed based on cost. And I think this one should give us what? Is it 27,000? 27,000, 0.2 of 135. 135,000. Yes, 27. So then we move back to point number 4. In point number 4, the last sentence, we are told depreciation and the repair on farm machinery are to be charged to the general statement. So there is something also we need to capture here as per note number 4, the repair of farm machinery. Repair of farm machinery. And this one is given in the trial balance. So the repair of farm machinery in the trial balance, where do we have this? We have these somewhere in the middle, just below the purchases. Below the purchases, we have the repair of farm machinery. And the repair of farm machinery, I think that is a value of, is it 1875? 1875? Yes. So we are done with that point number 4. And then we go to point number 5. We compute depreciation on buildings. Depreciation on buildings, we are told, this one will be 2.5% of the cost. So what is the cost of the buildings? That one is given in the trial balance, the first item up there. The cost of